This week revealed a slowdown in GDP growth and an acceleration in inflation. According to one analyst, the economy could be on the verge of delivering the worst of both worlds. Let's dive in. Before we begin, remember to like this video and subscribe for more economic updates. One of the low points of the last several days was the Commerce Department's report on Friday that the Personal Consumption Expenditures Price Index rose more than expected in March. Headline, or all items, PCE increased 2.7% year over year, a tenth of a point faster than the estimate and 0.2 of a point faster than February's pace. Core PCE, which excludes food and energy prices, rose 2.8% on an annual basis in March, same as February but a tenth of a point faster than projected. As George Mateo, Chief Investment Officer at Key Wealth, noted, the prospects of rate cuts remain, but they are not assured, and the Fed will likely need weakness in the labor market before they have the confidence to cut. Also this week, two different measures of activity in the housing market suggest that sector remains resilient despite the persistence of higher mortgage rates. On Tuesday, the Census Bureau reported that sales of new homes increased more than expected in March, jumping to a seasonally adjusted annual rate of 693,000 units. That's an increase of nearly 9% from the downwardly revised 637,000 units sold in February. Economists had expected to see sales of new single-family homes rise to a more modest 670,000 last month. On Thursday, the economy received good news about the health of the housing market with the release of the pending home sales index for March by the National Association of Realtors. The NAR reported that its index of homes under contract jumped 3.4% last month to a measure of 78.2, the highest measure of the index in 11 months. Economists had expected to see the index climb a much more modest 0.3% in March. On Tuesday, S&P Global produced some disappointing numbers of its own on recent business activity with the release of its Flash Purchasing Managers Indexes for April. As it turns out, the Flash PMI numbers, which are an advanced look at final PMIs, fell in both the manufacturing and services sectors this month. The bigger news was in the manufacturing PMI, where the decline to 49.9 from 51.9 in March dropped the index into contraction territory for the first time since December. As for services PMI, that still showed expansion this month, but the drop to 50.9 from 51.7 in March now means that metric is at its lowest level since November. The Commerce Department delivered more bad news this week when it reported both a big decline in GDP growth and a big jump in quarterly inflation. On Thursday, the agency's advanced estimate of GDP growth in the first quarter indicated the economy grew at an annualized rate of 1.6%. That's well below the 2.2% rate projected, and less than half the 3.4% rate recorded in the previous quarter. Perhaps the bigger and more disappointing news from the report was the reveal that both the headline and core PCE price indexes came in hot for the first quarter. Headline PCE landed at 3.4% annualized last quarter, a big increase over the 1.8% rate posted in the fourth quarter of 2023. Quarterly core PCE showed significant acceleration over the 2% rate posted in Q4, coming in at 3.7%. As the economy appears to be heading in the wrong direction, that's all we have for now. But make sure to join us on Monday as we continue to keep you updated. This is Devlin Steele for Augusta Precious Metals signing out.